love to call Malik Diallo, who's the VP for EMA Sales at S&P Global Commodity Insights. Woo, that was a mouthful, to do an opening remarks. Thank you so much. A round of applause, everybody. Thank you.
All right. First of all, a warm welcome to everyone, each of you, and our here VIP guests and honorable guests. Thank you for taking out the time to join us this afternoon. We really appreciate your presence here. And I think your presence here in itself reflects our shared commitment to exploring the dynamics of the, I would say, oil and energy markets in Africa. And we have put today an agenda together, and I promise you, it's going to be a very good one. It's going to take you into the intricacy of the oil market and energy market in Africa. And we're going to start off with two of my colleagues, Dex and Dan Evans. They're going to talk about the future oil market and the challenges of evaluating the crude benchmarks. We're also going to touch on the evolving balances of refined products in Africa. And I'm sure they're going to shed a lot of light on the opportunities and the challenges in Africa. Right after that, we're going to have my brother, Dr. Al-Farouk from West Africa, and another brother from West Africa, Zakaria Dosso. Today is a West African invasion here. You're going to have to bear with us, but you are going to enjoy that. So Dr. Al-Farouk will talk about the Apple, the strategic vision, and the hydrocarbon in Africa. And Zakaria Dosso, I don't see him, might be somewhere here. We need you because without the bank, without the money, there's no light. So we have a banker here who's going to talk about the strategy of his bank, the milestone, and I will encourage each of you as well to ask as many questions as you can possibly do. And we'll close up the session with a panel discussion and to talk about the future energizing of Africa and how Africa can forge their own path. Because it's very important, we're talking about energy transformation, energy transition, but energy transition and transformation does not mean the same things if you're in Brussels, you're in Dubai, or you're in Cape Town or Lagos. That's very important. So for now, before my colleague Dan comes on stage, I'm going to ask you to familiarize yourself with the antitrust rule. Because we being a PRA, it's very important that we highlight that. And with no further ado, I'm going to hand over to Dan Evans. Dan, over to you. Thank you.
Thank you, Malik. Thank you, Malik, and hello, welcome to you all from me. It's great to be here in Cape Town. It's great to be at Africa Energy Week. For the South Africans in the room, I hope you're not too exhausted after last night. It was pretty harrowing experience. We'll be able to debrief that in the networking reception later on, but bear with us. Let us talk a little bit about the energy markets first. So I'm going to share with you our view on the short-term outlook, how we see crude oil markets and the refined product market evolving in the period between now and the end of 2024. I'm going to share with you our view and explain a little bit why we believe this and some of the risks around our outlook to the market outlooks. But first, I want to just spend a couple of minutes framing how we look at the market. And as we know, the oil market goes through different eras. And I think we would argue that the conflict in Ukraine has ushered in a new era for oil markets. It's really been a turning point. And of course, a turning point means that the future is not going to be the same as the past. We've seen many things change. I've listed 6 of them up here. But I think from an African perspective, I really want to draw your attention to 3 of them. The first is the de-integration between Europe and Russia. We've seen that totally remake the global crude oil and refined product trade picture. All of the crude oil that was flowing towards Europe from Russia is now flowing eastward. As a result, European refiners have had to look elsewhere for crude, and they've looked at Africa and other parts of the world to backfill that void. The same thing's happened on the refined product picture. Europe banned the import of Russian products, and as a result, we've seen them scramble to find supply elsewhere. That pulled Middle Eastern barrels away from Africa, and Africa has had to look for alternative sources of supply. That change in trade is something that we expect to be durable going forward. The second shift that we've seen is with thinking about the energy transition. We've gone through the first energy crisis of the energy transition. We've seen price spikes, exceptional volatility in energy markets, supply shortages. All of that has shifted us away from this linear thinking about the energy transition to having a much more nuanced view. There is a greater acceptance that fossil fuels, that oil and gas are going to be required for the long term, and as a result, that's starting to unlock some of the financing or access to financing that is going to be required to invest in African energy and African infrastructure over the decades to come. And then thirdly, I think if we had to name this era, we'd probably call it the era of government intervention. We're seeing governments intervene in the energy market in a massive way. That's multifaceted. It's the weaponization of energy, it's bans, it's sanctions, it's subsidies, it's taxation. I think the bottom line is it's an additional risk that we're going to have to manage. It's a risk that we expect to stay in the market for some time to come. So let's start by looking at the crude oil market, and I think we could say that governments are intervening in the crude oil market for sure. We have an engineered deficit in the market, which is keeping it tight. Basically, there's a lot of oil out there, but OPEC Plus is keeping oil back from the market, looking for a price level that is relatively high by historical standards, this sort of $90 a barrel. Now, we think that OPEC Plus can be successful in managing the market, providing three things happen. Firstly, that OPEC Plus continues to show supply restraint, and that means maintaining cuts through the end of this year and through the whole of 2024. Secondly, that the organization remains open to making further cuts if they're necessary. And thirdly, that demand continues to perform. Now, our view is that OPEC Plus is open to making further cuts if necessary. Perhaps the bigger question is, when will the organization start putting more oil back into the market? And our view is that unless oil is above $100 a barrel for a period of time, that's not going to happen. Now, the third point says that demand growth is not the problem. And actually, we're expecting pretty solid demand growth this year, 2.1 million barrels a day, 1.7 million barrels a day next year. That's pretty strong, given the economic climate. The problem, though, is supply growth outside of OPEC. And that's also been very strong. It's been growing faster than demand. So I'm going to come back and look at our price outlook at the end, but you know, I've got it here. We're expecting prices to be in the high 80s through the remainder of the fourth quarter and average in the high 80s in 2024 as well. I'm not going to talk about geopolitics, but obviously it has a huge impact on the oil market, and we've all got our eyes on what's unfolding in the Middle East right now. So, as I said, right, the main issue that OPEC Plus is trying to manage is this picture here. We've got very strong demand growth, 2.1 million barrels a day, 1.7 million barrels a day next year. But this block, this OPEC Plus, this supply growth outside of OPEC is outstripping demand. So what that means is that in order to maintain the tightness in the market, OPEC Plus is going to have to cut and keep cutting to balance this situation. Now, demand is not the problem. Demand has been very strong. Here we're showing Chinese demand, the blue, and then gold demand from the rest of the world. And we've seen that 2.1 million barrels a day of growth by historical standards is pretty good. China has delivered a lot of that growth, but our expectation is that China, the era of China being the growth engine for oil demand is over, right? And as a result, we can prepare ourselves for slower year-on-year growth going forward. Now, the title of this slide says it's not the problem yet, and the implication there is that it will be, and it will be soon. And the reason for that is this picture. So here we're showing US gasoline demand, but the picture is pretty similar for demand in many mature markets. We're arguing that there are basically three phases of demand. There's growth, plateau, and decline. And in many parts of the world where oil demand is concentrated today, we're entering that decline phase. And that's going to mean lower year-on-year growth going forward. Next year, the expectation is that demand growth again is going to be pretty solid. We've got 1.7 million barrels a day of growth. China is not driving that. It's coming from the continued jet fuel recovery. Here, you can see that jet fuel demand is still below 2019 levels. Petrochemical feedstocks are also playing a big role in driving some of that growth. But 1.7 million barrels a day is a pretty big number, and I think if we had to identify where the risk was, we'd probably say that it's more likely to be on the downside than the upside. In terms of the supply growth, where's it coming from? It's mostly an America story. Here you can see 2022, 2023, the US is contributing a big slug of that growth. That's going to be the same as we move into 2024, even as we see private operators bring the rig counts down. But it's not just about the US. Brazil is hitting record production levels. Guyana is lifting production. And we're also seeing new supply come online from Canada as well. As non-OPEC plus supply continues to grow, the gold here, what we're seeing is the need for OPEC plus to cut. So about 1.5 million barrels a day down in terms of production in 2023, a further 500,000 barrels a day of cuts expected in 2024. So, significant effort will be required in order to balance the market. Who's making that effort? Well, as you can see from this chart, it's mainly, but not only, Saudi Arabia. So Saudi Arabia is the green, and what we've seen is that they're willing to make unilateral cuts, willing to keep cutting in order to keep the market in this tight situation. And the result of that is a lot of spare capacity, a lot of oil that's being kept off the market. Here what we're seeing is the spare capacity from Saudi Arabia, Kuwait, and the UAE. So there's a lot of oil that's not being put into the market. And what that means, of course, is that Saudi Arabia has huge power in the oil market right now. The ability, depending on the strategy, to push prices higher, but similarly to bring prices much lower. So really watch what the Saudi strategy is going to be in terms of managing the market. Looking at our balances, here what we're showing is global oil supply, the gold line, and global oil demand, the blue line. The bars are showing surpluses and deficits. The surplus is the green. So as we're moving into the end of this year, we're seeing that shrinking deficit turn into a surplus in the first half of next year. We're expecting inventories to start to build again. Directionally, that will start having downward pressure on prices. And then as demand starts building seasonally again in the middle of next year, we're expecting that surplus to turn into a deficit, inventories to start to draw down again, and getting that upward support for prices. So that momentum is echoed in our price look. Here we're showing three different cases, but I'm going to focus on the base case. You've got that movement that echoes the inventory builds and draws, and essentially we're arguing that the effective market management will be able to keep the Brent price in that $80, $90, $100 a barrel range. That, again, is dependent on these three things being true. Continued supply restraint. Nobody gets too eager to put more oil in the market with prices at these levels. The willingness to continue cutting, particularly if demand doesn't meet the expectations. So I'm going to move now to talk about refined products, and I think we would argue that if the tightness in the crude oil market is a engineered tightness, the tightness in refined products markets is structural. And that's, of course, leading to this period of exceptional profitability, which we've been calling the platinum age of refining. So the origin for that is really the big wave of refining capacity closures that we saw in the wake of the pandemic. So here what I'm showing is refinery closures in red, refineries that have opened or will open in green. And what we saw in that period was basically demand crashed. Over 4 million barrels a day of refining capacity was closed globally. And since then, demand has bounced back, and refiners have really struggled to keep pace with meeting that demand. It's a global story, but we'd argue that that tightness is more significant in the Atlantic Basin. Basically, we saw most of the closures there. The demand rebound has been quickest there. And of course, the Russian barrels are not in the North Atlantic Basin, at least. It's a bit of a different story east of Suez. We've seen less capacity close, more being added, the demand recovery being slightly slower, and of course, more Russian crude and product flowing into the region. So we've got two things that have happened. The first is that we've got global tightness, which is lifting prices higher, crack spreads higher, but you've also got this emerging structural east-west divide. And one of the places where we see that is in the pricing or the shift in the pricing of gasoline and diesel. So here what I'm showing is the difference in pricing between gasoline in the Atlantic Basin and in Singapore, and really just focus on these two horizontal lines and the numbers. Before January 22, gasoline in Singapore was more expensive than it was in the Atlantic Basin. Since then, it's become more expensive relatively in the Atlantic Basin. It's the same story on diesel. That difference, there's been a step change, a step up. Diesel has become much more expensive in the Atlantic Basin than it is east of Suez. We expect that to continue. We expect it to continue until we get into a more balanced situation in the Atlantic Basin, and also until freight rates come down. And freight rates coming down will really require new tanker capacity being brought online. If we look at our balances, we see the tightness is going to persist through the end of 2024. Here we're looking at supply minus demand, excluding biofuels, relative to 2017, 2019. Gasoline on the left, gasol on the right. And really, what you see is that when the blue lines are below this horizontal axis, it means the market is tight. And so for gasoline, all the way through the end of 2024, we're expecting to see tightness in the market. Same story for diesel, maybe a bit of upward momentum at the end as new projects come online. So real tightness in both of the key refined products markets. Our view is that tightness only really goes away when new refining capacity is brought online. Here, these blocks are showing blocks of new capacity, new refineries that are being brought online. You can see there's a lot of new capacity coming. This line is showing the cumulative change in nameplate capacity, and by the end of 2023, we think we're going to have more capacity than we did at the end of 2019, and it's going to keep growing. But look at this picture with a pinch of salt, because starting up a new refinery is a complex and time-consuming business. It doesn't always go smoothly. What we're showing here is the startup timelines of 3 refineries that were built relatively recently, and we're showing 3 things on each of them. When the refinery first receives crude oil, when commercial operations start, and then when they reach a sort of steady state in terms of utilization and product loadings. And you can see that it takes a long time. Even in this case, the Star refinery in Turkey, which was pretty smooth, took 15 months. In other examples, we're talking about 2, 3, 4 years. So given that a lot of the capacity that's being brought online right now is going to be big, it's complex, we can expect some teething problems. We can expect a slow startup. So what that means is that there's a discrepancy between the nameplate capacity and the available capacity. So here what we're showing is additions and closures, And the dotted line is the nameplate capacity. And as you can see, by the end of this year, we're going above 2019 levels, and we keep adding capacity. This line, however, takes into account the expected startup of those refineries. And you can see that the available capacity is set to remain below 2019 levels even by the end of 2024, even with that significant number of projects being commissioned. Now that translates into fairly modest additional volumes of refined product coming into the market. So here what we're looking at is gasoline from new projects, diesel from new projects. By the end of 2024, we're adding just 200,000 barrels a day of gasoline supply. We're adding more on the diesel supply, but in both cases, the supply additions are falling behind the demand growth in the same period. So the market is set to remain tight. Now, we've got structural tightness in the market, but that doesn't mean that governments aren't intervening in refined product markets. A couple of weeks ago, the Russian government decided that it was going to temporarily ban the export of gasoline and diesel. They cited problems with the domestic market, and we agree, right, that the export economics were looking much more attractive than selling product domestically. But Russian taxation isn't really the topic here. I think the message is that, the world's biggest diesel exporter banning exports, even temporarily, is a big deal, right? And it's just a signal that there's additional risks to manage in terms of anticipating what governments might do, and that changes, and that can be unpredictable. And we don't know whether it was a one-off or whether it's something that might be repeated. And these kinds of interruptions, I think, are particularly problematic for Africa. Here we're showing how trade has changed since the EU ban on Russian product. We've seen this flow of Russian diesel into Europe disappear. Europe's pulled barrels from the Middle East. That's taken volumes away from Africa. Africa has backfilled from Russia. But any disruption to refined product markets is problematic for Africa because there's less ability, less willingness to pay, and also with logistical bottlenecks, with relatively little product being held in storage, very little strategic storage, it doesn't take long before any supply disruption starts to have an impact on consumers. Turning back to the global picture, an additional bullish signal is just where we are on stocks. Here we're looking at light distillate stocks. We're looking at where we are in 2023 relative to the average, relative to the range. And you can see that we're low. We're low in the US, we're low in Europe, and it's a similar story on middle distillates. Again, they've started ticking up, but they're still low by historical levels. That's a signal that the market is tight, but also that it's expensive to hold stocks. Another bullish signal is just refining outages. We're starting to see refinery outages tick up, both planned and unplanned. Planned outages are increasing because people are still suffering from a maintenance backlog. People couldn't get crews in to maintain assets during COVID, and as a result, they've delayed maintenance. They're now having to execute that. We're also seeing unplanned outages increase. Basically, people are running into reliability issues. The margins have been good. People have been running assets hard for a long time. Stuff is starting to break. So that, again, is contributing to the available capacity being significantly less than the nameplate capacity. And as a result, right, we're starting to see that translated into the crack picture, into the margin picture. Here on the right-hand side, I'm showing our outlook for diesel, gasoline, and naphtha cracks. You can see that diesel and gasoline look pretty good, maybe not as good as last year, but our expectation is that with this tightness in the market, we're going to see higher than average cracks through the remainder of 2024. That translates into positive margins, really strong margin environment that we're anticipating for refiners globally, but particularly in the Atlantic Basin through the end of 2024. So we're expecting this sort of slow sunset, the sun to slowly set on this good period of refining margins. So I'm going to finish there and just leave you with a couple of messages. The first is that we see both the crude and the product market remaining tight. That's positive for prices and margins. There's this engineered deficit in the crude market. There's this structural deficit in the product market. So in terms of what to watch is what could take us away from these optimistic views of prices and margins, I would say, firstly, on the crude market, watch the big actors, watch the geopolitics of oil. On the refined product market, look to the fundamentals, look at what's happening to demand, look at how quickly some of these projects are being ramped up. So with that, I will finish.